So what really is creating stock market returns? Is it luck? Is it timing? Is it randomness? Or is there a hidden formula? So if you can crack that formula, you will know the path to consistent compounding returns, doubling your money, or even multiplying your money 10x or 20x or even more. This chart reveals some secrets. The green bar here represents the profits of the 30 companies that comprise the Sensex, and this reflects the overall health of the economy. As the earnings of these companies grow, the Sensex also rises, showing a strong correlation between the profits of the companies and stock market returns. So to predict where the stock market is headed, track the profits of the companies in Sensex. When the profits grow, stock market typically grows and gives return. Over the last 5 years, Sensex earnings have grown at a compounded annual rate of 17%, and investment in the Sensex has also yielded similar returns, including dividends. The returns are even higher. So if you had invested 38,600 in Sensex in 2019, it would have grown to 84,000 and the profit would be about 45,000. So your investment has increased by about 118% since 2019. That's doubling of your money. Of course, this is not magical. It has happened because the profits of the Sensex companies have increased over time, and the profit per share of Sensex was 1,500. Now in 2024, it has doubled to 3,300. These companies have more than doubled their profits. It has grown by 120%. The profit of the 30 companies took 4 years to sometimes double. Sometimes it has taken 7 years to double and sometimes more. This shows the unpredictability of the equity markets to generate consistent returns. There is a high variance in the profit growth. However, over 30 years, the very long term, your investments have generated about 12% approximately. Many new investors, including millennials and the Gen Z, have entered the stock market in the past 4 years, and they have enjoyed continuous upward trajectory of the markets. With the markets rising consistently, it's easy to adopt an expectation that this will be a one-way uptrend and this will go on indefinitely. But this experience gives a sense of false confidence or optimism. Conversely, investors who have invested during periods of 1996 to 2003 faced a very challenging environment. Those 7 years were characterized by stagnant returns, with many experiencing zero gains over the long, frustrating 7 years. Such an experience teaches a very different lesson about market returns and behavior in general, leading investors to adopt a very cautious or a suspicious approach to stock market. They stop believing that stock markets are a reliable avenue to generating returns. So different mindsets. There is a stark contrast between the investors of these two periods, and it shows how recency bias can shape an investor's investing strategy and how they can choose the funds, etc. So those who have only witnessed bullish markets may overlook historical volatility and the potential downturns, while those who experienced flat or zero returns during those 7 years may be very conservative and risk averse towards their investment strategies. As an investor, it's essential to recognize both the past experiences and the current experiences, how they influence our decisions. A well-rounded approach that considers both the recent trends as well as historical performance and downturns can help in reducing the risk associated with recency bias. There is another fascinating aspect hidden in this chart. In the year 2008, Sensex was at 21,000. It then crashed to the bottom of 8,000 by March 2009. The Sensex had lost 60%, and if you had invested exactly at Jan 2008, you have lost 60%. But if you invested regularly like a SIP, the portfolio would have been negative 30% only, approximately half of the previous scenario. Now, the most important part, By June 2009, that is 3 months later, Sensex had recovered and climbed to 15,600, almost doubling from the bottom in about 3 months. So your SIP portfolio is already positive and at no loss. If you had continued to invest regularly during the sharp correction of 60%, that is from Jan 2008 for 15 months, your portfolio at this point of March 2009 will be negative 30%. But in another 3 months, the portfolio would have shown a positive 30% approximately. See what 3 months time can do to a seemingly bad investment portfolio, from a poor minus 30% to a plus 30%. Well, this is an approximate calculation. The actual returns might vary depending on when you bought the Sensex and at what level and dates. But the idea was to communicate the key message. Regular investing through SIPs can significantly reduce losses during such market downturns, and it can also enable quicker recovery. So it is the resilience of the investor, the discipline of staying invested and investing regularly, that can change a negative experience to a positive experience or to a positive portfolio. Remember, Sensex is still down 26% here from the top, but the mutual fund portfolio created through regular investments during this long phase is plus and generating positive returns already. So it is not possible to manually decide when to invest. You cannot time the market. It's very unpredictable. So making regular, consistent investments is far more effective than trying to guess where is the perfect moment to invest. However, one can use some broad guidelines on when to push the pedal or when to slow down a little bit. One ratio you can monitor is the yield ratio. GSEC yield is the return offered by a government bond, which is considered to be a risk-free investment. Earnings yield, on the other hand, is the inverse of price to earnings ratio. Lower yield ratio is when it is below historical averages, and this can signal a good time to invest in the stock market. When it is above historical average, you can consider allocating lesser to equity. Right now, it is just above historical average. Another important concept in this presentation is about sector allocation, investing in sectoral funds. Sectors which have performed exceptionally well in the past 1 year or 2 years have started to underperform, indicating a clear sectoral rotations, sectoral changes in the market. For instance, in the past year, defense, public sector enterprises, and realty were among the best performing sectors. However, during the very recent market correction, these sectors saw the steepest declines. Defense, for example, corrected by 20% from its peak, while the broader market represented by the Nifty 50 saw only 1.5% correction. However, public sector enterprises have not corrected that much. This highlights the most important point. When investing in top performing sectoral funds, you must be prepared for potential reversals and keep an eye for the continuation of the trend or a break and reversal. It is tempting to invest in these sector funds due to recency bias, where recent success, recent high performance influences our decisions to invest. But caution is needed in such investments. Mutual funds also capitalize on this behavior, often launching new funds, that is NFOs, in sectors that have recently performed very well, like the recent NFOs on the defense sector. While sectoral funds can be profitable if you time it right, it's crucial to recognize that market timing is very, very difficult. So, if you do not have the time and the capacity to monitor these changing shifts, it would be better to adopt a flexible approach, a flexi-cap approach, and settle for slightly lower return profile than adding unmanageable risk. Similar is the concept of investing in one specific type of funds, for example, quality or value. Value had a long underperformance for 3 years, during which quality was the best performer. Many mutual funds garnered huge AUM, which is quality based for 3 years, but they went on to disappoint investors as value started outperforming in the last 4 years. Recently, we have seen a change back to quality. It's anybody's guess whether this will continue. So all this information can be used to design a portfolio that doesn't chase the best performer, but rather it focuses on a balanced performance approach. If you would like to receive a copy of this report discussed here, please email here. Please like this video, share it with your friends who might benefit from these mutual fund insights, and also consider subscribing to this channel so you do not miss out new videos.